Mark, as we wait for Nvidia then, what is catching your eye in the global narrative? Are we pausing for breath on the higher yield story? Is that the message out of Japan and, again, here in Europe as well?
I think that the yields move is getting to those levels where this is getting close to the end for the now. I'm not quite sure it's over yet. I think what is interesting is that bond markets are suddenly, over the last week, the last 9 sessions, or 7 trading sessions, I should say, have priced in the Strait being closed for a substantial amount of time, but central banks being asleep at the wheel. And that's why we're seeing the long end in particular get hit. We're seeing that steepening. If they thought central banks were going to react to inflation, then we'd see more aggressive flattening. So that the bond markets are kind of pricing the Strait closed almost in isolation. We're not seeing it in other asset classes. The other thing out there is, just as you guys have been discussing with Neil Campling, is I think the Samsung story is potentially massive. We just outlined recently that Samsung and SK Hynix are 2 of the 5 most influential stocks on global portfolios at the moment, given their volatility and what that's having on other asset classes. Not 2 of the 5 largest in terms of market cap, 2 of the 5 largest in terms of impact on global portfolios. And I think because retail is driving the trade, they're kind of ignoring what's happening on this Samsung strike. And if the strike does go ahead, you've got a major problem on Korean stocks, which are really kind of the bellwether or the poster for AI retail enthusiasm. And I think that will have massive contagion effects. Never mind the secondary effects that Neil Campling was arguing about, the fact that we might have a shortage of memory chips later on. That's another problem. Just the immediate stock market impact will be quite large. So I think there's quite a bit going on at the moment, and I'm getting a little bit more nervous again.
What about what's happening in the Gulf? Getting nervous there?
Well, my base case assumption is that there must be material escalation to resolve it. Now, obviously, I have no geopolitical insight or kind of special kind of knowledge there what the US is going to do. But there doesn't seem to be an obvious resolution. And that needs to be resolved. If that is not resolved, we're going to get major asset price dislocations in the coming months. So even though material escalation perhaps this weekend would be negative in the short term and see dramatic headlines, that is actually the better outcome for risk assets. I'd be much more bearish if we are not getting the Strait resolved anytime soon.
Mark, can I just tie that back to your first answer on what we've seen in terms of the bond markets? If we start to hear more hawkish tone from central banks and action potentially, does that then put a cap on yields, particularly at the long end?
So that'll see front-end yields go higher again. It'll probably be more problematic for stocks just because we get a further kind of tightening at the front end. But ultimately, yes, we will see flattening. It'll get everyone kind of realizing, hey, we're going to have a growth impact here because the central banks are tightening financial conditions just as we're getting a stagflationary impulse. So we'll see a flattening of the curve. We'll see the long end come lower while front end goes higher. Either way, it wouldn't be great for stock markets, which is why I think the deterioration there is going to linger a bit longer.
OK, continued pressure, at least in the short term, across the global equity markets.